Welcome to Control Plus Q, where we discuss economics, finance, and investment from the perspective of high school students. Hello, everyone. In this episode, I chatted with Isaac about mutual funds and the importance of long-term investing. Do you want to just start talking about what is a mutual fund and how can people use mutual funds in order to invest and yeah.
Yeah, so mutual funds, when they were created, what, in the 70s, the 80s, maybe? Don't hold me to that. They are a mutual fund basically is a basket of different investments. There's
Right.
mutual funds on pretty much everything out there now. Mutual funds on stocks, bonds. I'm not sure if they have anything on crypto, but do have a mutual fund. They have mutual funds basically that are excuse me, like strategy based. It could be like US based long only or large cap or small cap, medium, mid cap to growth versus value to target based funds, international commodity based alternatives. So basically what it does, if you were to instead of you buying a bunch of stocks and
Mm-hmm.
put it in your portfolio, you could literally go out and buy a mutual fund that's, let's say, similarly set up as how you have it in your own portfolio. And what that does, it allows you to kind of allocate more capital into different areas instead of tying up your money in that like all these stocks. You can just buy one mutual fund or one share or however many shares and kind of mimic that same allocation, but then you have extra money to allocate into other areas. So uh, there are some very key differences, though. There's things, basically, you don't know what the price you're paying for it or the price you're selling for it until after the market close.
Mm-hmm.
So there's a big disadvantage. I think there's actually quite a few disadvantages. And I'm just going to put it out black and white. I'm not a big fan of mutual funds. I really feel like they're like the really old school method of investing. Um, my rationale is because mutual funds, there's companies that have taken it too far. They charge a lot of fees internally. Vanguard's a pretty good one. They're probably the best one as far as very affordable. They still have a little charge on that, um, but basically when you see other mutual funds, you really need to pay attention to the fees that they charge inside of them. But the biggest going back to the difference, you don't know what you're buying, you don't know what you're selling. So essentially, it's going to tell you the price per share of that mutual fund. But if the market was up for that day and you decide to buy it, well, you wouldn't be buying at that close. You'd be buying at the today's market close, which is going to be higher than what it's going to show. So that's somewhat of a disadvantage because what if the market went down first and then went back up? Because that happens all the time.
Right.
Well, I mean, you could literally you'd be buying at the highest, or not the highest, but you'd be buying it right at the close. And if the market closed or if that mutual fund closed at its high, you'd be buying at the high. Whereas if bought a slightly like a similar product like an ETF, you could kind of pick and choose that, you can try to time it a little bit better, but like your entry point is a lot better. So
Mm.
that's a big disadvantage. There's the fees that come along with it. So a mutual fund carries these internal fees. One's called an expense ratio, and that's kind of no different than any advisor charging a fee. Um, Expense ratios are you don't actually see them deducted out of your account. You see that really reflected off the price per share of the mutual fund. So let's say you bought a mutual fund and
Mm-hmm.
the share price was $100. Okay. And the expense ratio is 1%. If the mutual fund did not move for the full year, stayed the exact same price, well, the mutual fund would actually be at the end of year one would be now worth $99 per share because they pulled out their 1% over that period of time.
Oh, I see. So it's kind of like diverse or with derivatives a little bit. I don't know.
No, no, not like that. It's just more to do with how they pull a fee. Like
Uh,
you don't see it, like we go to the ATM or Yeah,
Right.
if we need to pull money out, right? We see it deduct out of our bank account right away.
Yeah.
This is a little different. Like you don't see any deductions, but what you do see is you'll see the price per share will kind of get eroded a little
Mhm.
bit by their they take the I don't know when they some mutual funds take it monthly, some take it quarterly. But what happens over time, if let's say the mutual funds stay the exact same price for like 10 years, or let's just say 100 years,
Mhm.
then basically the price per share would go from 100 all the way down to zero because they were taking out $1 every year or 1%.
Oh, I see.
Yeah. So then there's another fee called a 12B1 expense, which is an internal marketing fee. And that's usually around 25 basis points or 0.25%. And then there's usually, not usually, but I run in this half the time, but there's a front end load fee. These are the ones that probably most concern me and frustrate me the most because what they you have mutual fund companies that are basically charging, usually it's right around 5.75% just to buy a mutual fund. It's
Mm.
like what? So essentially the first year, if you're paying 5.75%, you're paying a 1% expense ratio and like one another 0.25% on the 12B1 fee. You're basically spending like literally 7%, almost 7% basically on any new money, So it's
Right.
something I run into quite a bit. So I'm not a big fan of mutual funds because they tend to be very inefficient. It's like, why would I get a mutual fund when I can get an ETF, which does the exact same thing, but it's generally a lot cheaper, like
Yeah.
substantially cheaper.
Yeah. Could you just explain what an ETF is? It's like,
Mhm. So a mutual fund we know is a basket of different securities. So if we take that, let's say we'll go back to like the mom and dad example.
yeah.
The dad is this, the dad is a stock.
Hmm.
The mom is a mutual fund. Okay, they came together. They had a kid. The kid would be an ETF, meaning that you can have an ETF that is diversified like a mutual fund, but then it trades just like a stock.
Mm.
So no longer do you have to like, you essentially wouldn't have to worry or not worry, but you're not so much concerned about, hey, what price am I going to get filled at? No, you know exactly what price you're going to get filled at because it trades like a stock. But
Mm.
you also know that it comes with the benefits generally of being diversified in a set of securities. Now, not all of them are like that because there's an ETF on gold, which is like GLD. All it invests is in gold. So it's
Right.
not really diversified. It's just pegged to the price of actual gold. So, but that's kind of like you do have a lot of ETFs that are sector based weighted. We actually use quite a few of those, but overall they're very liquid. They trade a lot, so you know the price. There's not much of a high spread between the bid and the ask. So we know exactly what price we're getting at. And generally there is an expense ratio inside of these, but I think most places is like zero point 0.1 or less per
Okay.
year per year. So, essentially point one, I mean, if it's a $10 per share, they're taking out a penny a year. So, which is very nominal, very, very not, or very, very minute, I should say, minuscule. So yeah, so that should hopefully answer that question on the ETF.
That is all for this episode. Thank you for listening, and I will see you next time.